Religion and finance seem like opposite domains, one concerned with the sacred and eternal, the other with the profane and transactional. But this apparent separation is historically recent and conceptually false, because the earliest credit systems emerged directly from religious institutions. Temples were the first banks, priests were the first accountants, religious obligations were the first debts, and the entire conceptual framework of debt, obligation, repayment, redemption, these are fundamentally religious concepts that were secularized into finance, not the other way around. And understanding how this happened, how religion created credit and how credit shaped religion, reveals that our modern financial system has theological roots that persist in surprising ways. The language of debt is shot through with religious terminology. We speak of paying our debts as moral obligation, of redemption and forgiveness, of owing and being owed, of settling accounts, and these aren't metaphors borrowed from finance into religion. They're religious concepts that finance borrowed and literalized. The original credit system was sacrifice, the idea that you could give something to the gods now, create an obligation, and receive benefits later, either in this life or the next, and temples formalized this system, keeping accounts of sacrifices made, debts owed to gods and by gods, creating the first written records which were accounting documents tracking religious obligations. And gradually this religious credit system became a template for secular credit. Temples began offering actual financial services, loans and deposits and currency exchange, alongside their religious functions, and the transition from religious to secular credit was so gradual and so intertwined that separating them is impossible. They're the same system, expressing the same fundamental logic of obligation and repayment, just applied to different domains. The earliest writing we have, from ancient Sumer around 3200 BCE, isn't literature or law or kingly propaganda. It's accounting, tablets recording quantities of grain and sheep and beer, tracking who gave what to whom, who owed what to whom. And these tablets come from temples, from religious institutions that were managing the economic life of early cities. Temples owned enormous amounts of land, employed thousands of workers, collected offerings and taxes, and they needed to track all of this. Needed to record obligations and payments, needed accounting systems, and so writing was invented, not to record speech or ideas but to record debts, to track what was owed, and the earliest accounts tracked both religious obligations, sacrifices promised to gods, offerings made, and economic obligations, grain stored, labor owed, loans made, and these weren't clearly distinguished. Owing grain to the temple and owing a sacrifice to the god were recorded the same way, were part of the same system of obligation, and the temple bureaucrats who managed this system were priests, religious officials, who saw no contradiction between sacred and economic functions. They were managing the god's property, the god's wealth, serving the gods by ensuring that obligations were met and accounts balanced. The conceptual foundation was sacrifice, the idea that by giving something valuable to the gods, you created relationship, created obligation. The gods would reciprocate by providing protection, good harvests, victory in war, whatever you needed. And this wasn't seen as crude barter. It was more sophisticated. You weren't buying specific services, but creating ongoing relationship, making deposit in divine favor that you could draw on when needed. And different sacrifices had different values. A bull was worth more than a sheep. Regular offerings created more favor than occasional ones. Large donations brought more blessings than small ones. And temples kept track, knew who had given what, who had accumulated how much divine favor, and would remind people of their obligations, suggest that perhaps more sacrifices were needed to maintain good standing with the gods, and this created a kind of account system. You had a balance with the gods, and you could be in credit or in deficit, and being in deficit was dangerous. The gods might punish you, might withhold blessings, might actively harm you. So you needed to maintain good standing, needed to keep your account in credit. And this was managed by priests who served as intermediaries, who knew the gods' preferences, who could advise on appropriate sacrifices, who could intercede on your behalf. The extension to actual credit, financial loans, happened naturally within this framework. Temples accumulated enormous wealth from offerings and tithes, more grain and animals and precious goods than they could use immediately. So they stored it, created the first treasuries, and people who needed grain to plant or to survive until harvest could borrow from the temple, receiving grain now with obligation to repay later, typically with interest, and this was understood in religious terms. The temple was lending the god's property. The debt was owed ultimately to the god, not just to the institution. Repaying the debt was sacred obligation, not just financial contract, and defaulting was sacrilege, offending the god, risking divine punishment. So temple loans were very secure. People would starve rather than default on temple debt, because default meant spiritual as well as financial ruin. And this made temples excellent creditors. Their loans were repaid reliably, their wealth accumulated, and they became the dominant economic institutions in early civilizations, the first banks in everything but name. And some scholars argue they were banks in name too, that the word we translate as temple and the word we translate as bank were the same in some ancient languages. The institutions were identical. The development of money was also closely connected to religion. The earliest money wasn't coinage but standardized valuable objects that could be used for payment, and these were often religious objects. Cattle in some societies, because cattle were sacrificial animals, their value established by their use and sacrifice. Shells in other societies, because shells were offered to gods and used in religious ceremonies. Metals like silver and gold, because they were used for religious purposes, making temple vessels and decorations, and so objects that already had sacred value became monetary value. The two were interchangeable, and when coinage was invented around the 7th century BCE in Anatolia, temples and other religious institutions were among the first issuers. They had the authority and trust to guarantee the value of coins, had the precious metals to make them, and had the need for standardized currency to facilitate their economic operations. So early coins often bore religious symbols, were guaranteed by temples or by kings claiming divine authority. The connection between sacred and monetary value was literal, stamped on the coins themselves. The extension of credit logic to afterlife and salvation is where religion became fully a credit system. The idea that appeared in various forms across many religions, that your actions in life created a kind of account that would be settled after death, that good deeds accumulated credit and bad deeds created debt, and that the balance would determine your fate in the afterlife. This is most explicit in traditions with clear accounting like Egyptian religion, where the heart was weighed against a feather in the afterlife. The weighing was literally judging whether your account balanced, whether you'd lived righteously enough to enter paradise, or like later Christianity where salvation was described in explicitly financial terms. Humanity owed a debt to God because of sin. The debt was so large that humans couldn't repay it. But Christ paid the debt through his sacrifice, redeemed humanity, bought us back from damnation. This is credit terminology applied to salvation, the entire soteriology is financial, and it made sense to people because they already understood credit relationships, already lived in a world where debt and obligation and repayment structured social life. So describing spiritual reality in the same terms was natural, wasn't even really metaphorical. It was the same logic applied to a different domain. The medieval Christian church developed this credit system to extraordinary sophistication. The treasury of merit was literally an accounting concept. The idea that saints through their exceptional virtue had accumulated more merit than they needed for their own salvation, and this surplus was held by the church in a kind of treasury, and the church could dispense this merit to others through indulgences. You could buy an indulgence which would draw on the treasury of merit to pay down your debt of sin, reducing time in purgatory, and this was explicitly described in financial terms, with specific sins having specific prices, specific amounts of merit needed to offset them. And indulgences could be bought not just for yourself, but for dead relatives. You could pay to reduce their time in purgatory, and the church marketed indulgences aggressively, sent preachers to sell them, used high-pressure sales tactics, and accumulated enormous wealth. And this was controversial even at the time. Critics objected that the church was selling salvation, commercializing sacred, but defenders argued that indulgences weren't payment for salvation, which couldn't be bought, but were payment to draw on the treasury of merit that the church legitimately held. It was financial transaction within a religious credit system, and the distinction between selling salvation and selling access to merit was subtle enough that many people didn't understand or care about it. They just knew they were paying money to improve their afterlife prospects, and the church knew it was generating revenue by monetizing its spiritual authority. The Protestant Reformation was partly a revolt against this financial religious system. Luther's critique of indulgences was that salvation couldn't be bought or sold, couldn't be reduced to financial transaction. Faith alone saved, not payments to the church. And this was theological argument, but also economic and political. It was challenging the church's economic power, its ability to extract wealth through religious credit system. And Protestant theology generally tried to separate sacred from financial, tried to argue that religion wasn't about accumulating merit or paying debts, but about faith and grace, gifts that couldn't be earned or bought. But even Protestant theology remained saturated with financial language, speaking of redemption and ransom and paying the price of sin. And Protestant practice quickly developed its own financial religious systems. Tithing was mandatory in most Protestant communities. Church attendance and contribution were tracked. Moral behavior was monitored, and those who transgressed faced penalties. The accounting continued, just in different form. And the Protestant work ethic that Weber famously described, the idea that worldly success was sign of divine favor, that wealth accumulation demonstrated election. This created its own credit system, where financial success became spiritual credit, proved that you were among the saved, and poverty became spiritual debit, suggested you were probably damned. So Protestantism didn't eliminate the financial religious connection, just restructured it. The Islamic prohibition on riba, usually translated as usury or interest, represented an attempt to limit the financialization of religion, to separate sacred obligations from financial ones. Debt was permitted, but charging interest wasn't. This was supposed to prevent exploitation, prevent the kind of debt bondage that interest created, and to keep economic relationships more equitable. And Islamic finance developed elaborate techniques to comply with this prohibition while still enabling credit, mudaraba, and musharaka, and various partnership structures where instead of lending at interest, you'd invest in a venture and share profits. And these were religiously permissible because they involved risk-sharing rather than guaranteed return, but in practice they often functioned similarly to interest-bearing loans. The distinction was formal more than substantive. And Islamic financial institutions today offer products that are Sharia-compliant in structure but competitive with conventional finance and function. So even the attempt to separate religion from financial credit led to creating alternative religious credit structures rather than actually separating the domains. The modern separation of church and state, of religion and finance, is partial and recent and incomplete. We've created secular financial institutions, banks and bond markets and central banks that operate independently of religious authority, and we've reduced religion to private belief and voluntary association, removed its economic power, but the conceptual framework remains religious. The language of debt is still theological. The moral weight we place on repaying debts, the shame of default, the idea that debts must be honored even when doing so causes suffering. These are religious values that have been secularized. We've forgotten their religious origin, but we still enforce them with religious fervor, and modern capitalism, particularly financial capitalism, functions remarkably like medieval Christianity's treasury of merit, complex accounting of who owns what, who owes what to whom, promises of future returns that depend on faith in the system, elaborate hierarchies of claims and obligations, all maintained through record-keeping and enforced through institutional power. The Federal Reserve and major banks serve roles similar to what the Vatican served. They're the authorities who manage the credit system, who can create money, who decide who gets credit and at what price, and faith in the currency, trust that the financial system will function. These are crucial to making it work, just as faith in the church's authority was crucial to making indulgences work. The anthropologist David Graeber argued that debt is fundamentally a moral concept before it's an economic one, that the idea of owing, of obligation, of reciprocity, these are social and ultimately religious concepts that only later get quantified and financialized, and that this history matters because we think about debt wrong. We think of it as neutral financial contract when it's actually moral relationship laden with assumptions about obligation and honor and redemption, and this explains why debt is treated so differently from other contracts, why defaulting on debt carries moral opprobrium that breaking other contracts doesn't, why societies that would never enforce a contract for personal services will rigorously enforce debt collection. It's because debt isn't just contract, it's moral obligation with religious roots. And this also explains why debt forgiveness is so difficult politically. Why even when forgiving debts would be economically rational and beneficial, societies resist doing it. Because forgiveness requires acknowledging that the debt wasn't real obligation, wasn't sacred duty, was just accounting entry that can be erased. And this challenges the entire moral framework we've inherited from religion, challenges the idea that debts must be paid, that obligations are sacred, that accounts must balance. The persistence of religious language in finance isn't accidental or metaphorical. It's inheritance. Modern finance is secularized religion. It took the credit system that religion created, the accounting methods that temples invented, the moral framework of obligation and repayment that sacrifice established, and it applied these to purely economic relationships, stripped of explicit religious content, but retaining religious structure and assumptions. And this is why financial crises feel like moral crises, why debates about debt and credit are so emotionally charged, why we speak of moral hazard and talk about who deserves bailouts and who should suffer. These are theological debates using economic language. We're arguing about who has sinned and who should be punished and who can be redeemed, using the framework that religion gave us but pretending it's just economics, and understanding this history, understanding that religion became the world's first credit system and that our credit system remains fundamentally religious even after secularization. This helps explain why finance operates the way it does, why it resists reform, why attempts to make it purely rational and economic always fail. Because finance isn't purely rational and economic, it's moral and religious. And until we recognize that, until we acknowledge the theological foundations of our financial system, we can't really understand it or change it effectively. The implication is that financial reform is theological reform, that changing how we handle debt requires changing our moral and quasi-religious assumptions about obligation, that debt jubilee or other radical reforms aren't just economic policies, they're challenges to sacred principles. They're asking us to reject the idea that debts must always be repaid, that obligations are absolute, that accounts must balance. These ideas that religion installed in us and that finance inherited, and this explains why even when reform is obviously needed, even when the alternative is crisis and suffering, we resist it because we're not just changing policy, we're challenging religious principles that we may not even recognize as religious because they've been so thoroughly secularized. But the resistance we feel is religious resistance. The discomfort with forgiveness and cancellation is theological discomfort. We've inherited from millennia of religious teaching the idea that debts are sacred, that obligation is absolute, that repayment is moral necessity, and we can't just decide through rational analysis to abandon these ideas. They're too deep, too fundamental to how we think about right and wrong. And they were installed by religion when religion became the world's first credit system. When temples started tracking who owed what to whom and to the gods. When sacrifice became accounting and accounting became theology. And that original fusion of sacred and financial, established thousands of years ago in Mesopotamian temples, persists in secularized form in modern finance. In how we think about debt and obligation and repayment. In the moral weight we give to financial contracts. In the theological language we still use even when we don't believe in the theology, because religion created credit and credit remains religious, even now. Even after we've forgotten the connection, the structure persists, the assumptions remain, and understanding this, understanding that our financial system has religious foundations that were laid when writing was invented to track temple accounts and sacrifice was formalized into the first credit system. This is necessary to understanding why finance works the way it does and why changing it is so difficult, because you're not just changing accounting methods or institutional structures. You're challenging theological principles that are thousands of years old and deeply embedded in how human societies think about obligation and reciprocity and what we owe to each other and to the powers, whether we call them gods or markets, that we believe govern our lives.